Another violent overnight move shook the metals market again. Silver plunged hard, briefly printing lows near $71 per ounce, forcing another wave of positions out of the market. Gold followed with its own sharp sell-off, touching the low 4300s before stabilizing and snapping higher. What followed was an aggressive rebound. As I'm recording this in the pre-market hours, silver has recovered from 71 to roughly 83. That's a 17% rebound off the lows in a matter of hours. Gold has clawed back around $250 of the roughly $450 it lost. From the intraday bottom, gold is now up about 7%, while silver is up closer to 15%. The bounce is meaningful, but the volatility is extreme, and now all eyes are on the New York session to see whether this recovery holds or fades. In my prior videos, I outlined very specific scenarios for silver, and I made it clear why Bitcoin was the key leading indicator. Large shifts in global risk sentiment almost always show up in crypto first, particularly in Bitcoin. When capital starts to pull back or de-risk at scale, Bitcoin tends to move ahead of traditional commodities, giving us an early warning signal. That's why I emphasized one critical level, where Bitcoin would close over the weekend. I said plainly that if Bitcoin closed below the 80 to 82,000 zone, we should expect selling pressure to spill over into other markets. That is exactly what happened. Bitcoin closed near 76,000 with an intraday low around 74,500. I was very explicit that a test of 74,000 or lower would confirm serious weakness. That level wasn't random. It was the foundation of my bearish short-term framework. And what followed was textbook spillover selling. Silver was hit aggressively, collapsing to $71. Then came the relief rally, a sharp 17% snap back toward 83. Now we wait. The New York Open will tell us whether this bounce has real strength behind it, or whether the bearish scenario resumes with another leg lower. I read every single comment from yesterday's video, and I want to say thank you. It's powerful to see how many of you are using this information to make clearer, more disciplined decisions. The comments showed a clear split in perspective. Some of you are preparing for additional downside, while others remain focused on the longer-term macro thesis. That split doesn't mean confusion. It means people are thinking independently and executing their own plans. That's exactly what this community is about. We don't follow crowds. We don't chase hype. We don't sell fear or fantasy narratives about overnight riches. This is real market analysis, dealing with real risk in real time. I need to repeat something important, especially for anyone new here. I do not sell signals. I do not sell courses, mentorships, or paid groups. Anyone claiming otherwise is lying and should be blocked immediately. I operate only on X and YouTube under the name eRogJohnAG. No other accounts, no private messages asking for money. Protect yourself. My only goal is to provide a clear, unfiltered view of what's happening in the markets. Now let's look at the data as it stands pre-market. Shanghai spot silver is trading around $11.99. SHFE futures are near $11.42. Western spot pricing sits around $83.47, with futures matching that level. The premium between East and West is currently about $18.50, translating to roughly a 22% premium. That's down from the extreme 40+% premium we saw over the weekend, but a 22 to 23% premium is still enormous. Volatility remains extreme, and again, we're waiting on New York. Zooming out, the scale of this move is staggering. Roughly $10 trillion in market value has been erased in just 3 days. Gold is down about 20% from its peak, wiping out roughly $7.4 trillion in value. That's multiple times the entire market cap of Bitcoin. Silver has fallen nearly 40%, destroying about $2.7 trillion, roughly equal to the entire crypto market. Assets traditionally viewed as safe havens are trading with the volatility of speculative tech or meme assets. This is the continuation of the Kevin Walsh Fed chair sell-off narrative. But what makes this different is what is not happening. Central banks are not dumping gold. Major entities like Tether have not sold their gold reserves. Governments have not suddenly solved their debt problems. In fact, the US government is facing shutdown risk because spending issues remain unresolved. So why is gold being sold this aggressively? The answer appears to lie in liquidity stress, not fundamentals. Nothing material changed in the macro backdrop since Thursday. What likely changed is stress somewhere in the financial system. When liquidity dries up, funds don't sell what they want to sell. They sell what they can sell. Gold and silver are liquid, profitable positions for many institutions, making them the first assets liquidated when margin calls arrive. This is what a liquidity event looks like. When gold sells off alongside falling equities, falling crypto, declining yields, and a strengthening dollar, that combination signals stress, not normal price discovery. Historically, when gold is sold in this manner, it's often a warning sign that something larger is breaking beneath the surface. Now, let's address the evidence that this is paper-driven, not physical. In Singapore and Australia, buyers are lining up to purchase gold. Silver, in many cases, is already sold out. In Hong Kong and parts of China, queues aren't forming simply because premiums are so wide and supply is constrained. European dealers have pulled silver offers entirely. Despite collapsing paper prices, retail demand for physical metals remains strong. This divergence matters. The Reserve in Singapore, one of the world's largest private silver vault operators, reported that physical silver demand actually increased during last week's crash. They see the gap between paper and physical markets widening, not narrowing. On China's largest e-commerce platform, JD.com, silver is currently priced around $163 per ounce. Compare that to COMEX pricing near $83. That's roughly a 95% premium. Silver remains in backwardation, signaling physical scarcity. You cannot resolve a physical shortage by smashing paper prices. What's happening has little to do with supply and demand and everything to do with financial stability. Paper manipulation is being used as a pressure valve. Shorts are attempting to suppress prices while managing exposure. But this strategy carries growing risk. We are in the middle of a revaluation process for precious metals, particularly silver. COMEX and LBMA inventories continue to drain, while physical demand stays firm. Looking at futures data, net volumes tell a different story than price. Despite the aggressive sell-off, overall volumes remain relatively balanced outside of large, concentrated dumps. This suggests price is being pushed lower through spoofing during low liquidity overnight hours and wash trading during U.S. sessions. That pressure triggered forced unwinds in leveraged ETFs, accelerating the drop. None of this reflects weakness in physical fundamentals. Chinese markets show stress as well. SHV silver futures hit daily limit down levels, locking trading with heavy one-sided selling. But physical vaults remain stable. Premiums are holding. Once again, paper is breaking, physical is not. Now, let's talk about what New York could bring. First, the bearish case. If selling resumes at the open, silver could retest 71 or break lower. CME margin hikes are now in effect. Traders unable to post additional capital may be forced out. Bitcoin has already confirmed weakness by breaking below 74,500. If it continues lower, risk-off pressure spreads. Add to this the fact that nearly $10 trillion in U.S. government debt matures over the next year, the largest amount in history, and must be refinanced at higher rates. This creates systemic stress across markets. In deflationary crashes, metals often fall alongside equities initially. Until deleveraging ends, pain can continue. Now the bullish case. The rebound from 71 to 83 is holding pre-market. If New York builds on that strength, silver could reclaim the high 80s quickly. Sharp drops are designed to flush weak hands. The macro backdrop hasn't changed. Debt, deficits, geopolitical risk, and monetary uncertainty all remain. Volatility does not automatically mean trend reversal. Silver remains deeply undervalued relative to equities. The gold-to-silver ratio remains far above historical norms. Physical availability ratios continue to tighten. When fundamentals reassert control, silver has explosive upside potential. So what am I watching? First, whether the bounce holds or fails. Second, Bitcoin's behavior near 74 to 76,000. Third, equity market stability. Fourth, Shanghai premiums. If they hold or expand, physical strength remains intact. And finally, any headlines related to banking stress, government shutdowns, or geopolitical escalation. Here's where we stand. Physical and paper markets are completely disconnected. Physical demand is strong. Paper markets are under stress. One of these breaks. History suggests it's paper. New York will help determine whether 71 was the low or just a pause. Volatility remains extreme. Leverage is dangerous. Think independently. Manage risk. Watch the data, not the noise. Stay sharp.